Hello, and welcome to our video about the potential collapse of U.S. banks, the sudden collapses of Silicon Valley Bank and Signature Bank, the biggest bank failures since the Great Recession, have put the precariousness of lenders in stark relief. First Republic Bank was forced to seek a lifeline this week, receiving tens of billions of dollars from other banks. And fears about the stability of the banking system hit Credit Suisse, the battered European giant. The simplest way to think about a bank is that it takes deposits from customers and lends those funds to people who want to buy a house or to companies hoping to build a factory. The reality, though, is more complicated. That is what happened with Silicon Valley Bank, which regulators seized on March 10 and which investors immediately viewed as a possible harbinger of similar trouble at other banks. The problem for SVB was that it held many bonds that were bought back when interest rates were low. Over the past year, the Federal Reserve has raised interest rates 8 times to combat the highest inflation in generations. As rates went up, newer versions of bonds became more valuable to investors than those SVB was holding. With the tech industry cooling, some of SVB's customers began withdrawing their money. To come up with the cash to repay depositors, SVB sold $21 billion of bonds. The bank racked up nearly $2 billion in losses. Over the past decade, the banking industry in the United States has faced numerous challenges, including the 2008 financial crisis, the rise of fintech companies, and changing consumer preferences. These challenges have forced banks to adapt and innovate, but they also expose the weaknesses in the system. One of the main risks facing U.S. banks is the level of debt they hold. Many banks have significant levels of debt on their balance sheets, which leaves them vulnerable to economic shocks or changes in interest rates. Another risk facing U.S. banks is their exposure to high-risk loans. Banks have been lending to riskier borrowers in recent years, which could lead to higher default rates if the economy takes a downturn. The U.S. banking industry is also facing increased competition from fintech companies. These companies are often more agile and innovative than traditional banks, which puts pressure on banks to keep up. In addition, changing consumer preferences are also affecting the banking industry. More and more people are choosing to bank online or through mobile apps, which reduces the need for physical bank branches. All of these factors have put pressure on U.S. banks and raised concerns about the potential for a collapse in the banking system. If one or more banks were to fail, it could have a ripple effect throughout the entire financial system. To address these risks, regulators have implemented a number of measures to strengthen the banking system. These include stress tests, increased capital requirements, and more rigorous oversight of banks' activities. Despite these measures, however, there is no guarantee that U.S. banks will be able to withstand a major economic shock or crisis. Investors and consumers alike should remain vigilant and be prepared for the possibility of a banking collapse. In conclusion, the U.S. banking system faces numerous challenges that could potentially lead to a collapse. While regulators have taken steps to address these risks, the future of the banking industry remains uncertain. It is important for individuals and businesses to stay informed and be prepared for any eventuality. Thank you for watching.